Hey everyone, this is Dan. I published a video on February 23rd to talk about how to protect ourselves from a potential market crash. You probably know the S&P index dropped by about 5% in the last few days, and the Nasdaq Index dropped even more at about 10% in the last few days. Let's look at the S&P chart. This is the daily chart. I printed this chart around 3:20 p.m. today, and as you can see, in the last 10 days or so, S&P has been dropping and has lost about 5% from its previous peak. We see the sell signal here from DMI just when the dip started, and also confirmed by a sell signal a day later by MACD. Let's look at the S&P hourly chart. We can see that it's been following this very bearish looking downward channel in the last 3 days. At one point today, it was trying to break above that channel, but then it fell dramatically and went way below that and started to pick up afterwards. In the last 2 hours of the trading day today, it went back into the channel. We'll have to see whether it'll successfully break above this channel tomorrow or maybe sink further. Let's look at the potential support and resistance levels. This is a daily chart again for S&P 500. We closed today at 3,768. I see resistance levels at 3820 and 3880. If the price can break above these resistance levels, that'll be a very bullish sign. On the other hand, I see support levels at 3720, 3680, and 3560. The 3680 support point is very important. It is the 100-day simple moving average. Now, if the market fails to stay above the 100-day moving average, that's a very bearish sign. At that point, I will be selling a lot more of my long positions. I'll be talking a little more about that later on. Let's look at Nasdaq Index. Instead of using the Nasdaq Index, I'm using the QQQ ETF, which tracks Nasdaq with a correlation of almost 100%. As of today, we are down 10% from the peak. We've been seeing a tech sell-off in the last 2 weeks. And we see this sell signal from DMI just when the drop started, confirmed by the sell signal from MACD. Both very bearish signs. Let's look at the hourly chart for QQQ. I see this downward trending channel. As of yesterday morning pre-market, the price was trying to break above the channel, but it fell and came back down into the channel. And then today, early in the morning, it tried to break above that again, but then it fell again, came back down to the channel. Potential support and resistance levels. As of today, we closed at 304 for QQQ. I see resistance levels at 312 and 324. And I see support levels at 298, 289, and 283. Today, we closed actually below the 100-day moving average of 306. And that's definitely a very bearish sign. If you look at Google Trends, using the search phrases best stocks to buy and market crash, the best stocks to buy is represented by the blue line, which is my bullish indicator, and market crash is represented by the red line, which is my bearish indicator. As you can see in the last 7 days, especially as of today, the bearish indicator spiked up, the red line spiked up. That means there's a lot of bearish sentiment in the market. If you just look at the past 24 hours, we see the 2 peaks here of the bearish sentiment. The first peak was around 9 o'clock this morning, and the second peak was around 2 o'clock this afternoon. Then it came down again, maybe because the market was closing and people just got tired. Tomorrow morning, first thing, I will be watching Google Trends again and see what the market sentiment is. Now, what does this have to do with the stock market? Explained in my February 23rd video about market crash protection. In that video, I mentioned that when we draw the Google Trends chart for the 12-month period, using the same 2 search phrases, we saw this big bearish spike back in February and March of 2020 last year. And that corresponded exactly to the market crash that happened starting February 19, 2020. And that's why it's important for us to keep track of Google Trends to try to see where the market is going and whether there's going to be a crash happening in the next few days. A lot of people are saying that the market has been crashing because the interest rates have been going up, especially the Treasury rates. This is the chart of the 10-year Treasury rate for the last 12 months. Indeed, it's been going up. And this is the chart for the 30-year Treasury rate. Again, it's been going up. These two rates have doubled in the last 3 months. We'll talk about why the interest rates have been going up in the next few minutes. Before we move on, if you like what you've seen so far, please click the like, subscribe, and notification button so that you'll be notified when I publish the next video. Let's continue. This is a very important piece of news item. The Senate is in the process of reviewing the $1.9 trillion COVID relief bill passed by the House of Representatives. What does that have to do with the market? Let's look at what happened last year. First of all, as you remember, last year, right on February 19, 2020, the market started to crash because of COVID fear. And then the country started to shut down around March-April timeframe. Then, in response to the pandemic, the Congress passed the CARES Act, which was put into action on March 27, 2020, with a budget of $2.2 trillion for the stimulus programs. And then approaching the end of last year, the Congress and President Trump approved another stimulus program for $900 billion. Adding these two programs together, we have the total of $3.1 trillion of increased government spending. Now, how does the government fund this? Of course, by issuing Treasury bills and Treasury notes. In the meanwhile, while the market was dipping, the Federal Reserve Bank came to our rescue. Starting on the week of March 11th, the Federal Reserve Bank started to buy assets. When the Fed purchases assets, they buy mostly U.S. Treasuries and to some extent mortgages, but mostly U.S. Treasuries. However, when the Fed started to buy a lot more assets, the market already dipped 19% from the peak. And then the Fed continued to buy more assets. In the meanwhile, the market bottomed out at 34% from the peak on March 23rd. That's where the Fed was, just around that time. And the Fed had to continue to buy assets to boost the economy and to boost the market. And eventually, they bought a total of $3 trillion of assets. As you might know, when the Fed buys assets, they just create that money and put the money into circulation in the market. And a lot of the banks and a lot of individuals will end up using that money to buy stocks. And that's why the stock market is boosted when the Fed begins to buy more assets. That's what they call quantitative easing, QE. Between June of last year and today, the Fed bought an additional $400 billion of assets. You add up $400 billion with $3 trillion, that's a total of $3.4 trillion of assets that the Fed has purchased, which corresponds very well to the $3.1 trillion of additional spending from the government for the stimulus programs. In other words, the Fed pretty much absorbed the additional debts issued by the U.S. government. Now the government is talking about potentially spending another $1.9 trillion with the new stimulus bill. Now, who is going to buy these treasuries? Banks don't have enough appetite for so much debt. When there are not enough people to purchase debt, what's going to happen is that the interest rates will go up. And that's why we see the interest rates going up. It's to anticipate the issuance of the $1.9 trillion of debts from the U.S. government. Therefore, the Fed will need to buy more assets or else the interest rates will continue to shoot up and the stock market will continue to go down. In the meanwhile, I'm not going to wait for the Fed to bail me out because, as you remember from a couple of minutes ago, by the time the Fed started acting on March 11th of 2020, the market already dropped 19%. That's the S&P index. So far, we're only 5% from the top. Now, I'm not going to wait for the market to drop another 14% for the Fed to start helping me because, as you remember from last year, the market dropped a total of 34%. And that's why I'm already starting to sell my long positions and get into short positions, even though I know that the Fed will eventually come in and boost the market to turn the economy around. Therefore, my actions in the last few days include selling some of my stocks, including BioNTech, Moderna, Square, and the ARKG ETF. I also bought TQQQ, which is the triple inverse ETF indexed to the Nasdaq Index, and TMV, which is the ETF pegged to the 20-year U.S. Treasury bond. If the market continues to go down the next few days, I will sell more shares of stocks such as TSM, Taiwan Semiconductor, QCOM, ASML, Amazon, Microsoft, the ARKK ETF, and ARKG ETF. And I'll continue to reduce my other long positions and increase my short positions if the market continues to go down. However, I will keep some shares with good fundamentals for the long term, such as TSM, QCOM, ASML, mRNA, BNTX, and Berkshire Hathaway B shares. In the meanwhile, I will keep the gold ETF in my portfolio as a safety hedge. I will definitely follow the DMI and MACD indicators. Once I see the bullish buy signals from those two indicators, I will be nibbling, start to buy back long positions and start to reduce my short positions as I expect the market to recover eventually. But before that can happen, I'm pretty sure the Fed will have to intervene by buying more assets. If you're watching this video a few days after March 4th, 2021, you might want to check the update section right below this video in case I've entered some update notes. And if you like what you're seeing, I would appreciate very much if you can click the like, subscribe, and notification button so that you can be notified when I publish new videos in the future. As usual, I'll very much welcome your comments, questions, and suggestions. I thank you very much for watching all the way to here. In the meanwhile, I'd like to mention that I'm not a financial advisor. You should make your own decision when it comes to buying or selling financial instruments, and you should probably consult with your financial advisors before you do so. This wraps up my video for now. I will chat with you in the next few days. In the meanwhile, I would like to wish you the very best of luck with your financial investments.